Hi, my name is Stuart Weems. Welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to talk about policy risk, specifically how it applies to property investors, because I think this risk has emerged, or at least it was, much smaller, let's say 10 to 20 years ago, but certainly over the last decade or so, things have permanently changed with property investors, and it's a risk that we need to be conscious of. I don't think it's a risk that's going to disappear. And because government likes to meddle in lots of different businesses in lots of different ways, I think it's a risk that we need to think about. So what I'm really talking about is government policy changes. And that can come in terms of tighter tenancy laws. It can come in the form of higher taxation. Of course, I spoke about that yesterday at the beginning of yesterday's episode around the budget. And really, property investors really need to be rewarded for risk. And so where there's higher risk, we need, as investors, higher returns. So I've spoken about Coality's daily price index as because it uses a hedonic approach, which means it tries to compare apples with apples property attributes. I think it's a pretty good index to give us a broad sense of what's happening within property. Of course, there's properties really literally hundreds or thousands of different sub-markets. So it doesn't tell us what's happening in our suburb, for instance, but it gives us a general sort of theme for what's going on in markets. And I mentioned a few weeks ago that it started just a little over 15 years ago, coming up to 15 and a half years old now, that index. And when you look at how Melbourne's performed, it's only generated growth of 1% above inflation, which, is pretty underwhelming, I think, from an investor's standpoint. And again, a few weeks ago, I recorded a episode that sort of said, well, there's some properties in Melbourne that actually have outperformed the median, and that's really the goal, is to choose an asset that has fundamental attributes that are going to outperform. But as a general sort of theme, we've had very little growth in Melbourne at a median house level for the last 15 and a half years. Now, of course, that's the whole reason we invest in property is for capital growth. I'm happy to borrow to invest and lose money on my investment. If I lose, $1 on my investment, but I'm getting $10 in capital growth, I'm off to the races. That's kind of what I'm after. But, if you just look at that median data, you'd go, well, Melbourne investors, have faced materially higher holding costs. So the cash flow's worse. Control over the investment has been eroded because of tenancy law changes, and they haven't been compensated because of the capital growth rate. If we dig a little bit deeper on each of those things, if we talk about holding costs, they've significantly increased over the past 5 to 10 years. Not only things like insurance and council rates, but council rates always goes up, of course, and that's true for homes and investment properties. Let's not start on that third layer of government and whether it's worth paying a lot of money for people to come and pick up our bins. Well, it is, but not that much money, perhaps. You can always also think about land tax. Of course, Victoria has certainly widened the land tax net. A lot more people are paying land tax in Victoria than, say, in other states. And notwithstanding that, unfortunately, last 3 years, the time-weighted average interest rate has more than doubled compared to the previous decade. So, all those things conspire just produce worse cash flow. Alongside, increase in holding costs, it's reported that Victorian government has introduced 130 individual tenancy law reforms since 2018. So over the last 8 years, 130 new rules. Now, some of these rules are reasonable and some of them are necessary. I think, everyone deserves to live in a safe and livable property, of course, and no one's going to sort of argue against that. But the reality is that it creates compliance costs, so it does increase the cost profile of property, but also it reduces the investor's control over that property in terms of, whether you can move a tenant on, these sorts of things. And control is really one of the key attributes that attract investors to investing in property. I invest in ETFs. I've got no control over the index, of course. I'm just a passenger. With property, you can bequeath it, you can improve it, you can occupy it, you can put a tenant in it. I've got a bit of control how I use that asset. So let me give you a little bit of an example. One that I've sort of come across personally is that you can't advertise a property in Victoria unless it meets the minimum standards, which is an okay rule as a sort of in a general sense, but the implementation is nuanced, right? Because you might have a situation where you don't have, that one of the rooms in your property is missing a cord cleat. A cord cleat is one of those small plastic clips that secures a blind cord to the wall and, avoids obviously, problems if children get caught in the cord and so forth. So they're important, but they're relatively quick and easy and costless to fix, right? You can't advertise a property until it's 100% correct, until it all meets those minimum standards. It's a bit dumb, right? The implementation should have been you can advertise the property, but the person can't occupy perhaps until it meets minimum standards. At least you can do those things concurrently. And I had a vacancy and a challenge with arguing with the property manager to say, no, it's up to standard. Anyway, we lost a couple of weeks in terms of being able to advertise that property and extended the vacancy period, which is really dumb. So I guess, we want our tenants to live in a safe and comfortable environment, 100%. But also, government needs to understand they need to work with owners to achieve that outcome in an efficient manner, in a manner that minimises the cost on the landlord and the inconvenience to the landlord, while still achieving a safe and comfortable environment to live in for the tenant. Now, that's just one example, but there's been plenty of examples. I've got another one where a client had to get a statutory declaration to re-advertise a property from the previous tenant. So the tenant wasn't even a tenant in their property. They'd gone off and living somewhere else now, and we have to get a statutory declaration to re-advertise this property. It's a long story, but it's really dumb in terms of the implementation. And so, all these things kind of frustrate owners. They dissuade people from continuing to be property investors. And, private landlords provide more than 80% of rental accommodation in Australia. So we need landlords. And, with Melbourne's population growth, it needs landlords. But these rules, and I'll get to it in a minute because all the other states will have to come up to speed. So it's not just picking on Victoria here, but it's really about understanding as investors, how much control do we have over these very expensive assets? Let's not fool ourselves. We've got a lot of money tied up in these assets. So they're very expensive and we want to be rewarded for whatever risk that we take. Notwithstanding, to add to that, of course, as I said at the beginning of yesterday's episode, we could have, a greater tax drag in terms of changes to CGT coming our way as investors. All these things we need to consider and we need to be compensated for. Now, the other reality, and I've said it before in this podcast, I want it to be apolitical. This is not something for me to stand on a soapbox and lecture you over politics. Let's put that aside. But the reality is that the left side of politics really does have incentive to curtail price growth. I mean, actually, on one hand, it doesn't suit them because, there's plenty of voters out there that if the value of their home is not rising, or in fact, even if it's falling, that's not necessarily going to be, a positive from their standpoint. But if you think about Labor, they do rely on preferential voting. They do need to get the Greens votes. If they didn't get that in Melbourne, in Victoria, I should say, they wouldn't have won the last state election. And so, the government might be looking back and saying, look, 1% real growth in Melbourne over the last 15 years, they might not actually perceive that as a flaw. They may perceive that as a positive attribute, that it helps affordability and it probably helps them, with their relationship with the Greens. Now, I'm not mentioning this because I want to have a political conversation with you. I'm mentioning this because as investors, if we assume that Labor will hold government, either federally or on a state basis in Australia, in the locations where we have investment properties, we have to consider the risk that policies that reduce property price growth will have an impact on our investments. And we only need to look to the UK, for instance, as examples of how tenancy laws and higher taxation has certainly cooled growth in that market. Now, I don't want this podcast today to be about Melbourne only. Melbourne is a cautionary tale, I think, but this podcast is really about property as an asset class. And it's going to happen in other states as well. So in August 23, National Cabinet agreed to a 9-point plan to sort of harmonise renter protections across all states and territories. And so their commitments and this 9-point plan was around things like abolishing no grounds evictions, limiting rent increases to once per year, banning rent bidding, capping break lease fees, phasing in minimum property standards, standardising rental applications, and all these sorts of things. So Victoria is the most advanced jurisdiction with respect to this 9-point plan, and it's virtually implemented all the 9 points. New South Wales isn't too far behind. Queensland, South Australia and Western Australia probably mid of the pack. ACT's always been a highly regulated environment, and Tasmania and Northern Territory are probably lagging the other states in terms of these reforms. So if you have property outside of Victoria, you'll fall in line most likely with, Victoria's rules, whilst Victoria might be a little bit of an outlier at the moment. Really, I think we can expect these to be harmonised across Australia, which essentially means that all property investors will probably have just as much control. At the moment you'd say, well, Victorian property investors have less control than over their assets. They're very expensive and valuable assets than investors in other states, but that gap's going to close, of course. And holding costs, pretty universal, insurance premiums, council rates, notice increases, interest rates, all these sorts of things are pretty federal, they're not centred in Victoria. So, it brings up an important question. If tenancy laws will eventually be harmonised, and if other holding costs like interest rates and so forth are the same across Australia, why has Victoria suffered so much? Why has Melbourne property prices not grown for 15 years? And look, I acknowledge land tax is different in that, Victoria taxes spreads the land tax burden across more taxpayers than it does in other states, which means that someone that owns a relatively small valued property is still paying land tax, whereas that wouldn't occur in other states. So it could be land tax, but I doubt it's the primary driver of the returns. And I think I just put it down to sentiment, negative sentiment. Like Victoria's had some good news stories. I can hear my friend Pete Wargent thinking at the moment, no, Stuart, there's no good stories in Melbourne. But rest assured, we do have some good stories. Like, for example, Victoria has, in absolute terms, and only just a little bit off in percentage terms, the strongest population growth. And that's good positive news in terms of its economy. But unfortunately, any positive news is always overshadowed by a catalogue of negative events, whether it's poor fiscal management, rising state debt, new or expanding taxes, infrastructure projects that are plagued with cost blowouts, costly infrastructure projects that don't even have a business case. I'm talking the suburban rail loop for that thing, corruption, even more corruption, and obviously some of the longest COVID lockdowns, all these sorts of, the list just goes on and on and on. The problem isn't that we don't have any good news. The problem is it's always overshadowed by bad news. Now, many of these things don't really impact property directly. Some do. Just because you're paying extra $600 a year in land tax doesn't necessarily mean that asset is no longer, worth what it used to be worth, of course. It's not a positive, but it's certainly not a huge negative. But what it does impact is really overall sentiment with respect to the state. Now, and of course, sentiment will eventually change. We know that's for sure, and sentiment is never permanent. What's less known, of course, is when it's going to change. But we do know, and we've certainly observed this over the last couple of decades, that when sentiment does change, and you only have to look to, say, Queensland, Brisbane and Perth, for examples of this, it changes considerably. And the longer the market has been flat for, the more significant the upturn will be, the more aggressive the upturn will be. And we saw in Brisbane and Perth that, in the first couple of years of the growth cycle, they experienced substantial increases in property prices. It's not unusual to see like a 30 to 50% increase in some property prices. It will come back. So it's not all negative. And I think we've got to understand, and we've got to separate really Melbourne's performance from the theme that I'm trying to talk about today, which is policy risk. And policy risk exists across the board in Australia. And we can't confuse, the negative sentiment that's occurred in Melbourne and just attach it to the policy risk in Melbourne, because the policy risk isn't, as I said, just a Melbourne thing. It's an Australia thing. Now, I guess if we're going to see any positives here, the one positive is rental increases. In a market where investors are exiting and there's not a lot of good news to attract new investors to replace them, and that's a perfect description, I think, for Melbourne and has been for the last decade. If there's a contraction in supply, but, population growth is still very strong, that always translates to rental growth and rental price increases. And it's natural also for landlords, if they're experiencing higher costs, there's a cost pressure to pass those higher costs also on to renters as well. You can't always do it, but certainly in a market where there's a shortfall in supply, it certainly does give a little bit of pricing power back to landlords. And we're certainly seeing that in the data as well. So the longer a market is flat for, I think at least it's not going to fully compensate investors for it, but you can and you should expect to see certainly low vacancy rates with properties, and certainly the ability to pass on rental increases more so than in a very high growth market. What we tend to see in a high growth market is that rental increases start to become quite difficult, and you then actually see, just because the property value is rising, a contraction in rental yields as a percentage. The summation of this is that now I think policy risk is now a permanent feature of the environment. It's not a temporary headwind. It's something that Australian property investors need to get used to. Of course, as I said, tenancy laws will be across the board in Australia. They increase holding costs, reduce control. Property taxes, they're only going to move in one direction, whether it's land tax or federal taxes like CGT. And implementing policy that curtails property price growth, I think will be attractive to many governments. So they won't necessarily see that as something that's going to be a negative or lose them votes. And that changes the risk-reward position for direct property investors. And particularly when I started this business almost 25 years ago, it's significantly changed over that period of time. And this is not an argument against investing in direct property. This is an argument for having realistic expectations about the risk-reward returns that are present within the market. Now, that's fair enough. You're like, okay, Stuart, that's great. I acknowledge it. What do we do about it? Okay, well, let's talk about that. Because I don't think property is any longer set and forget. That used to be one of the, again, certainly 25 years ago when I started this business, it used to be one of the kind of main features of property. It is set and forget. Look, you buy it, you look after it, and then one day you wake up 30 years later and bang, you're sitting on a huge amount of equity. And you only have to look at, the last 20 years, the last 2 decades of returns, and compare that to the preceding 20-year period. So, in fact, if you do that, over the last 20 years, if you look at the median house price growth across Melbourne, Sydney and Brisbane, on average, it's grown at about 6% per annum. That's over the last 20 years. If you look at the preceding 20 years, the 20 years before that, it was around 8.5%. So we've got a 2.5% growth differential there. So it shows that set and forget sort of approach certainly served the previous generation and the previous generation of property investors, if you like, but it's not really serving the current generation. And I don't really expect it to change very much. Okay, so what more proactive approach can we take as property investors in the effort to try and generate higher pre-tax returns that offset some of these lack of control, higher holding costs and potentially higher taxation? Well, I talked about a value-add property strategy in December last year. So episode 387, if you want to go back and have a listen to it. And I sort of talked about buying an asset that is fundamentally sound, spending most of your money on the land value, something that's still in reasonable tenantable condition, and then making improvements to that asset after you buy it. So, but mostly cosmetic rather than structural improvements, as they're going to more significantly enhance the income profile and also the value of the asset. So they're the ones that are going to probably add the most amount of value. And so I'm talking about, new kitchen, bathroom, flooring, curtains, painting, these sorts of things. The other active elements that really come pre-acquisition, so you can't really manufacture them post-acquisition, are twofold. Firstly, uniqueness, and secondly, alternative use. So I think an asset with some level of uniqueness is going to be a positive attribute in terms of helping you outperform the market and therefore offsetting these rising costs. Knowing that, of course, things like insurance and council rates and interest rates and tenancy laws, they apply whether your asset is investment grade or not investment grade, right? They're going to be universal. So a really terrible asset is going to have the same cost and control issues, negatives, as a really great asset. So something that has uniqueness whether it's something like water views or in a fantastic street within that suburb, something that makes it just better than everything else, I think certainly helps us outperform. Now, of course, comes down or it's dependent on budget, but over the long run, that's really what's going to drive value. And then alternative use. So alternative use means that there's other ways where you're going to generate growth, where you're going to generate returns rather than just general market increase. So for example, I might buy a family home and that could be the core of my strategy. I'm going to buy this family home because it's sitting on a very valuable block of land, and that's where I'm going to get the capital growth from. But if that doesn't work out, I know that I can subdivide this family home and build 2 or 3 townhouses, for instance. Now, that's not the strategy, but at least I've got an asset that has an alternative use that if it doesn't work out, I can kind of manufacture a return. Now, you might not actually do the development. In fact, you probably wouldn't, I would say. You might just go and get the development approval and then sell it to a developer that's ready to go, that can, build and implement, that they've got more experience with building, implementing, and so forth. But it's an exit strategy that you can fall back upon if the general market growth isn't sufficient to drive the returns that you're looking for. So my first response to this increased policy risk is really about being a more active property investor, and thinking about things like alternative uses, uniquenesses with the property, and whether I can add value and manufacture an improvement in the income profile as well as the growth profile of the asset. The second reaction to this risk is diversification. It's not an option. I think it's a necessity. When I started this business 25 years ago, I kept saying that. I don't need to remind myself how long I've been doing this. But anyway, when I started my business that long ago, investing interstate was more of a personal preference. Like, we would speak to clients about it. If they weren't comfortable with it, no big deal. I think today, if your plan includes owning more than one investment property, I think diversification is absolutely critical. In terms of smoothing returns and reducing risk at a portfolio level, I think that can be really important. And, you only need to talk to Melbourne property investors to learn why that is important. And particularly Melbourne property investors that hold property interstate, like myself, will tell you that, if we didn't hold property interstate, our portfolios at a total level would be much worse off. And I think it's a lot easier these days to have property interstate, which is not to say that you should buy property without someone that you trust inspecting it, physically inspecting it. So don't go and buy property without having someone, sight unseen. That's just stupid. But, managing these sorts of things and looking after property that's interstate is, I think, a lot easier today than it was, say, 20 years ago. Now, apart from diversifying within property, I think it's also important to diversify in asset classes where appropriate, of course, because I talk about, stage of life, and when you're first starting out, your goal is to build your asset base and really investing in property because it generates most of its returning capital growth, and using gearing. Those two things put together are really the right asset. So you're not going to theoretically diversify 50-50, for example, between property and shares just because you think it's right. You need to pick a strategy that's appropriate for your age and stage of life. But just generally, I think aiming towards a diversified strategy makes sense. When you look at the global share index, the MSCI index, it's returned 9.5 to 10% over the past 20 years. So that's a pretty good return. Okay, you don't have the gearing and all these sorts of things that you got in property, but it's a very good return. And so, if you think about that, that's more than doubled twice over a 20-year period. If, invested $100, it'd be worth more than $400 now. So as I said, it will do most of the heavy lifting for you. And I guess similarly, if you've talked to a Melbourne property investor that has all their assets in Melbourne, but has a substantial amount of their wealth in shares as well, and it's been invested well, they're certainly, whilst they might be disappointed about the Melbourne property, their portfolio and net worth is still working forward. So diversification, I think, is one way to, it doesn't really change the policy risk, but what it does do is change the likely impact on your overall wealth journey as a result of changes in government policy. Okay, so just to sum up then, here's 5 points that I think, that my response to this higher sort of policy risk setting that's, permanently in place for Australian property investors. The first one is you need to really be more proactive and target higher returns. You need to understand that if that policy risk, or if you agree the policy risk is in place and the cost to hold property will increase, the control over the asset will likely decrease, and you need to, and then obviously the tax drag, the CGT, negative gearing, whatever it might be, whatever taxation we're talking about, could increase as well. Then ultimately, if you can invest in the asset and achieve the same outcomes, then you need to generate a higher return. In order to generate a higher return, you need to be more proactive. So that's number two. Be more proactive and really think about the type of property that will allow you to improve its value, improve its income profile. Number three, probably the best way to really cement above average performance is to have an above average property. So that really goes to having a property with some uniqueness or some optionality. Uniqueness, which makes it very highly sought after, or optionality, which gives you another way in order to generate returns other than general market growth. Number four, deliberately diversify. So whether that's diversifying geographically within the property market, not holding all your eggs in one state, or probably both, I should say, also diversifying across asset classes. My view's always been that most people would be well served by investing in both property and shares, and that neither asset class is necessarily better than the other. They all have their pros and cons, and at a portfolio level, they tend to work really well together. And finally, stress test holding costs and really property portfolio income profile. I answered a question yesterday in the Q&A with a listener talking about relying on 50% of their income in retirement coming from their property portfolio. And I cautioned that person about that and talked about how insidious land tax is and how it starts to really eat away at the income profile, to the extent that when we project these things, income is declining off a portfolio rather than increasing in dollar terms. So we really need to be very careful about our assumptions around property profile income and how that sort of works within our plan. So let's sum it all up then. Firstly, for those people that have invested in property within Melbourne and particularly held property over the last 10 or 15 years, don't worry. All markets will test our patience from time to time. An investor must have significant discipline to not react to periods of underperformance, assuming the original decision was fundamentally sound. All markets, whether it's a share market or property market or whatever, will test our patience at time, as I said. We just need to hang in there. What is certain is the market will bounce back. What is certain is that the longer the flat period, the more aggressive the bounce back will be. What is completely uncertain is the timing of that bounce back, of course. But a fundamentally sound investment grade asset will eventually deliver the returns that investors are seeking. For property investors that hold property outside of Melbourne, I think this is a good cautionary tale. It's a good cautionary tale to understand the policy risk, particularly if you're in some of those states like Queensland, WA and South Australia that haven't yet felt the full force of these National Cabinet decisions. You've got to realise that, hopefully the implementation might be slightly better than what Victoria's done, and maybe you can learn from that, but you've got to expect that, higher costs and less control over your asset is going to be a theme in the coming years. And I think investors need to recognise that and understand what they need to do about that, whether it's outside of that property portfolio in terms of diversifying or getting some geographical diversification as well. But essentially, I think that property landscape has changed. The risk return profile has changed, and we need to be really realistic about that as property investors. And we need to, include that assumption in our approach and our strategies. Okay, might leave it there for today. Thanks for listening. Until next week, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.